You make $110,000 a year. You have a real job, you pay your bills. Then you apply for a credit card, a car loan, an apartment, or a mortgage. And the answer comes back denied. Not because your income is too low, but because your file may look risky. Lenders don't approve your life, they approve your file. And today, in 8 minutes, you'll know the 5 signals that get high earners denied. Meet Marcus. Marcus is 34. He lives in Austin, Texas. He works in tech sales. Last year, he made about $118,000. So when Marcus started looking at homes, he thought the hard part would be finding the right house. He had the listing saved, he had already imagined the couch in the living room, he had checked the commute, he had looked at the photos more times than he wanted to admit. Then the mortgage pre-approval came back. Not the number he expected, not even close. Marcus thought the lender would see one thing, a 6-figure income. But the lender was reading something else, the file version of Marcus, and that file told a much colder story. Marcus made about $9,800 a month before taxes. That sounds strong. But the file does not stop at income. It asks a colder question. How much of that paycheck is already promised to someone else? Car payment, student loans, credit cards, personal loan, and now a possible mortgage. That is where debt-to-income ratio comes in. Not how much do you make, but how much room is left. Marcus saw a 6-figure salary. The file saw monthly obligations, a $720 car payment, a $500 student loan payment, $400 in credit card minimums, a personal loan, and a new housing payment trying to fit on top. That does not automatically mean denial, but it can change how risky the application looks. 2 people can both make $100,000 a year. Person A has almost no monthly debt. Person B has a car loan, student loans, credit card balances, and a personal loan. Same income, different file, different risk. A salary tells the system what comes in. Debt to income tells it what is already spoken for. This is the part that surprises a lot of high earners. Your income may be on the application, but your salary is not what makes up the credit score. The score is not impressed by your job title. It is not reading your LinkedIn. It is reading patterns. Did you pay on time? How much debt are you carrying? How much of your available credit are you using? How long have your accounts been open? Have you applied for new credit recently? Marcus had one credit card with a $10,000 limit. The balance was $8,500. In real life, Marcus felt fine. He was making payments, he had a good job, he was not panicking. But on paper, he was using 85% of that credit line. The file does not know his intentions. It does not know he planned to pay it down after his next commission check. It only sees the pattern. High balance, heavy use of revolving credit, more monthly obligations. From Marcus's point of view, he was managing it. From the file's point of view, he looked stretched. Some people avoid credit cards. They use debit. They pay cash. They hate debt. In real life, that can be irresponsible. But to the credit system, it can look like missing data. No long account history. No long record of using credit over time. Not enough reported behavior. This is often called a thin credit file. The system is not saying you are irresponsible. It may be saying, I do not know enough about you. Marcus did not have this problem, but his younger sister did. She had a stable job, low debt, paid rent, used debit for almost everything. Then she applied for a premium credit card. Denied. Not because she was dangerous, because the file was too quiet. In real life, she looked careful. On paper, she looked unknown. Now, imagine Marcus gets a raise. He feels like life is moving. So in the same month, he applies for a rewards card, a store card, a car loan, an apartment, and then a mortgage pre-approval. To Marcus, this feels like progress. He is upgrading his life. To the file, it may look different. Several new applications, possible new debt, a financial profile changing quickly. The story in Marcus's head is positive. I am moving up. But the signal on paper may be, Why is this person looking for so much credit right now? Are they about to take on more payments? Did something change? The file does not know the emotional story. It only sees the activity. That is why timing matters. Not just what you apply for, but how much activity appears in a short period of time. Sometimes the money is real, but the proof is messy. This can happen with freelancers, business owners, contractors, gig workers, commission-based workers, and people with multiple income streams. Someone might say, I made $130,000 last year. But the system asks, how much is stable? How much is documented? How much can we actually count? Marcus worked in tech sales. Part of his income came from commission. He knew the money was real, he saw it hit his bank account, but the lender wanted proof in a very specific format. Pay stubs, tax returns, bank statements, employment verification, commission records. Marcus knew the story, but the system wanted evidence. And that is where frustration happens, because your real life may be complicated, but the file wants clean boxes: verified income, verified employment, verified identity, verified address. The money may be real, but if the proof is unclear, incomplete, inconsistent, or hard to verify, the file can still raise questions. This is the easiest way to understand it. Every application creates a paper trail. Not paper as in actual paper. Paper as in the version of you the system can verify. Use the paper framework. P is for payments already promised. How much of your monthly income is already committed before the new payment even arrives? Car loans, student loans, personal loans, credit card minimums, and the new payments you are applying for. A is for available credit used. Are you using a small part of your limits, or does the file show you close to the ceiling? A person can pay on time and still look stretched if their balances are high compared to their limits. P is for payment history. Does the file show predictable behavior over time, or are there late payments, collections, charge-offs, or accounts you do not recognize? This is why the report matters, not just a score. E is for evidence. Can the system verify your income, job, identity, address, and documents? This can matter even more for people with variable income, self-employment income, commission income, or multiple income streams. R is for recent activity. Have there been new applications, new accounts, new debt, a sudden change in your financial profile? None of these automatically means someone will be denied. Approval standards vary by lender, landlord, product, location, and individual situation. But these are common areas that can help explain why a strong income may still lead to a no. Marcus thought his file said, this person makes $118,000, but the full file may have said, high monthly obligations, heavy credit card utilization, recent applications, commission income that needs more documentation. That does not mean Marcus failed. It means the file raised questions, and that is the key distinction. A denial is not a character judgment. It is a file decision. After a denial, do not only ask, why me? Ask, what did the file show? Start with the notice. The denial notice may list reasons for the decision or explain which report was used. Do not ignore it. That notice can give clues about what the file showed. Then check the report that may have been used. Look for wrong balances, accounts you do not recognize, incorrect late payments, old collections, duplicate accounts, wrong personal information, or anything that makes a file look riskier than it really is. If the decision involved the rental application, the issue may not only be your credit score. It may involve a tenant screening report, income verification, prior collections, unpaid balances, or other criteria. Rules can vary by landlord, location, product, and applicable law. This video is not legal or financial advice, but the broader point is simple. Sometimes the problem is not who you are, it is what got reported. A good income helps, but it does not erase a messy file. So if you were denied with a strong salary, do not take it as proof that you failed. Use it as a clue, because the goal is not just to make more money. The goal is to understand what the system is actually reading. If you want calm, simple breakdowns of the money systems that quietly shape life in America, subscribe for the next one.